In a previous lesson, we talked about life annuities, and we said that a life annuity is something that goes on for the rest of your life. So we sort of described it like permanent insurance. Well, today we're going to talk about term certain annuities. And this is really more like basically term insurance. One of the issues, if you remember in previous lessons about term insurance, okay, is that it does have an expiry date. Unlike permanent insurance, which basically insures you for the rest of your life, or in other words, a life annuity, which gives you an income for the rest of your life, a term certain annuity has an actual expiry date. So if, for example, you bought a 20-year term certain annuity, at the end of 20 years, the income stops. In other words, it will finish. So therefore, it's quite possible that you will be living longer than the actual term period itself. So one of the dangers of term certain is that you will outlive the payment, and as a result have no money in your later years. So it's very important that we pick these dates very, very carefully. However, that all said, the key word also here is certain, in that it is certain that regardless of what happens, this is a fully guaranteed product. In other words, once we start giving you your $5,000 a month, let's say, and let's say it is for 20 years, no matter what happens during that period of 20 years, you are going to be getting that $5,000. So in this case here, if you, for example, died in the 10th year, then your beneficiary will receive for the balance of that 10 year the same $5,000. So nothing changes here. So therefore, there is a beneficiary designation. Your beneficiary will take the same position that you were in before. But once again, when that 20 years is up, then the income stops. Unlike a life annuity, like I said, which could continue on, in a term certain, it will in fact have that have that particular expiry date. So it's very important that you time these things very, very carefully. Now that all said, there's basically a number of different kinds of term certain annuities. First of all, you can have a specified time, basically a specified term. So for example, I want a 5-year term, I want a 20-year term. So that's what they call a specified term. So you actually pick the time, and the insurance company will then calculate the amount you're going to get, and for that period of time, you will get that money, fully guaranteed. And once again, if you die within that specified time, so let's say it was that 20 years, you will, in fact, your beneficiary will receive the same amount of money as if you were still alive. At the end of that period, of course, it's all over. You can also what we call a specified term. In other words, you could say, in this case here, for example, you could say a specified, for 20 years. This in a term period, you could be 30 years, it could be 20 years. So these are basically the same kind of terminology and everything. You can also have a specified age. Okay, so it could be a specified term, it could be a specified age. So say, okay, I want to have an income until I'm 75. In other words, I don't anticipate that I'll live beyond age 75, so therefore I want to have an income to age 75. So you can have a specified age instead of an actual specified term. Okay? The last one is you can actually have a specified amount. In other words, you can say that you need a certain amount of income for a certain amount of monthly income. So, for example, if you tell us that you have to have $8,000 a month, for example, then the insurance company will do their calculation and they'll come up with the actual term. And they'll say, based on what you've given us, the lump sum, remember that all these things start with a lump sum of the money. So based on the money you've given us, and based on the interest rate that we're going to be able to pay you, we'll pay you $8,000. In other words, your specified amount. However, we will only going to be able to pay you, let's say, for 18 years. So and then you have to decide whether that's acceptable to you or whether that's not acceptable. The point is that basically once that period is all set, once the amount is all set, okay, then that is fully guaranteed for that particular period. So therefore, your beneficiary will receive whatever balance is not being paid, just as if you, in fact, were still alive. So basically, your beneficiary steps into your shoes. So the amounts of money are guaranteed. That the specified term, age, amount are fully guaranteed. So this is really what it does: is it gives you complete peace of mind that you know that for that whole period of time, for that whole amount, you're going to get that check, regardless of what happens to the economy.